Mayuresh, Joshi, fund manager at Angel Broking, joining in as well into the conversation. Mayuresh, afternoon, thanks for taking the time out today. What's it looking like? Markets again having just a little bit of a slow session, but you've seen a little bit of a rebound take place from those 68 or 100 lows that we'd seen a couple of days back.
Afternoon, Priyank. Clearly, I think we are mirroring what the global markets are largely doing at this point of time. And again, I think despite that, you're probably seeing with production freeze happening on the crude front by a lot of the OPEC, non-OPEC members, that is providing some respite on that front. But again, the volatility is continuing in terms of how the crude pricing might pan out, what happens with China data points, what happens with US data points. Domestic earnings have not been so great. Again, I think the capex cycle, the credit cycle is all that we're wanting to wait to recover over the next few months. So clearly, I think all these factors creating an overhang on the markets. Along with that, I think what really happens in the budget is a thing to be seen. So again, I think the volatility will continue. We're still expecting the markets to remain a little bit soft till we approach the budget, but it's going to be more stock-specific action at this point of time.
Okay, so that's as far as what we're seeing in terms of the way the market outlook's panning up. But in terms of the way some of these sectors are shaping up here as well, Mayuresh, let's try and get a comment from you on the banking pack. That really has been at the center of everything. PNB today is up almost 4.5%. ICICI Bank and SBI also been trying to give some bit of support. Are you looking at the banking pack right now, or do you believe there's still probably more pain to come there?
The pain will still persist for at least a quarter, and that's what a lot of the bank managements have mentioned, Priyank. So clearly, I think in terms of how provisioning pans out, specifically in terms of the RBI directive, are still going to create a huge amount of provisioning and GNPAs on a lot of bank balance sheets, specifically having a corporate exposure. Having said that, I think there has been meaningful contractions in forward multiples for the PSU banks. Private banks have not been spared either. So I think the pain might continue at least for a quarter or two, but if the credit cycle gets elongated and the economy probably goes into a slowdown phase, specifically looking into pointers with what the global economy does, you're probably looking at a delayed cycle come through. But our own take is that at least on the larger private sector banks, FY17 earnings should look a little bit more better, A, considering the base that will probably work for FY16, and B, I think the expectations of credit growth picking up over the next few quarters seem likely, with some pickup happening in industrial activity and manufacturing activity expected to pick up. So clearly, I think the stressed out sectors would see some respite. You're probably seeing cleaning up happening on the balance sheets. Balance sheets have become a little bit more cleaner, expected to become cleaner over the next few quarters as well. So earnings growth will be one key point to look out for, and even with one assumes credit cost to be on the higher side, the larger private sector banks is something that we'll still prefer. But again, I think it has to be only a 15% allocation at this point of time, not more than that.
All right, so that's as far as the banking pack is concerned. Now, aviation is a sector in focus on multiple news triggers. First up, data for January shows a 22% jump in passenger traffic. We also have some developments on the Jet Etihad deal. Let's bring in Hiral with more details on this. Hiral, take us to the highlights of the January aviation data first.
In terms of the aviation data, if you go to see, SpiceJet is a clear winner, with the January market share increasing to 13.2% from a 9.4%. Whereas if you see in terms of where Jet Airways is concerned, they have seen some bit of a degrowth in terms of market share, and that has come in at 21.4% versus a 23.2%. And in terms of where Indigo is concerned as well, we have seen some bit of a degrowth. However, it still stands to be the market leader in terms of where domestic airlines are concerned, and their market share stands right now at 35.6% from a 36.4%. If you see in terms of where the passenger load factor is concerned, SpiceJet has seen a number of 92.1% for January, and this is the highest amongst its peers. And even the cancellation rate for the airline is at 0.5%, which is the lowest among all the pan-India operators. If you see on the basis of the one-time performance, that is approximately 75%, and this is amongst the best in terms of whether industry is concerned right now. And additionally, if you go to see in terms of where Jet Airways along with Etihad Airways now has the largest market share in the Indian international traffic. So all in all, right now in terms of where SpiceJet is concerned, we have seen again in terms of where market share goes. However, Indigo as well as Jet Airways has seen some bit of a degrowth in the month of January.
All right, now Hiral, we also have development on the Jet Etihad deal. Etihad seems to be looking to hike their stake to 49%. What are reports indicating?
That's right. Reports are indicating that Etihad is looking to raise the stake in Jet Airways to 49% from the current 24% that they hold. And since we know that the FDI rules for the aviation sector are allowing foreign carriers to have up to around 49% stake via the automatic route, the move is not expected to require the approval of the FIBB. Now, recently, the two sides have reached an agreement to this effect after talks over valuations have got finalized as per what reports are suggesting. And Jet, as we know, has a total debt of close to 11,920 crores at the end of the third quarter. And now they want to go ahead and raise convertible bonds worth close to $300 to $400 million, for which reports do suggest that Etihad has already agreed. Now, once the conversion takes place, Etihad's stake will increase to 49%, and Jet will use these funds to pay its debt as well as expand its services. Additionally, we know that Etihad earlier had acquired 24% stake in Jet Airways for close to $349 million back then in 2013. And interestingly, one thing that we need to note now is that on Thursday, Jet Airways also decided to increase the number of daily flights to Dubai from airline hubs in Mumbai as well as Delhi. So all in all, much brewing in terms of where Jet Airways is concerned right now.
All right, so that's what we're seeing as far as the aviation back is concerned. Hiral, thanks for those updates. We spoke with Kapil Kaul of Kappa, who expects Spice to continue its outperformance in the quarters ahead. Hear him out.
SpiceJet's load factors would continue to be very high 80s and early 90s, largely because of the fact that they have a clear strategy in mind that it's not mostly yield driven, it is maximizing revenue on every flight. Given the constraint, they have a legacy issue with respect to their operations. So it's a strategy which I think is well executed on ground. But Q3 was excellent, and I see no reasons why, if the management focus continues to be the way it is, then the results will be in line with expectations, at least for the quarter four.
All right, so that's as far as the aviation pack is concerned. Mayuresh, any thoughts on what's happening here?
So clearly, I think there are developments that are happening, and again, I think it's largely a function of how load factors improve, which have seen some improvement for SpiceJet in this quarter. But clearly, I think the load factors is something to be watched out for as a key parameter. I think what has happened with crude, the ATF prices have seen significant correction in the past few quarters. And again, I think the expectations of crude staying in the range would mean effectively that ATF prices would largely remain benign for a lot of these airline stocks. So clearly, I think it is about volume improvement, about improvement of load factors and how they deleverage their balance sheets. However, I think the stock price movement of a lot of these stocks have been quite exuberant over the last few weeks and months. So clearly, I think we're still maintaining a neutral call onto the sector.
Okay, so that's as far as aviation is concerned. Now, BHL is taking a knock on in trade today as UBS has slashed its target to 70 rupees on the stock. What's making UBS so bearish? Hiral's here to tell us as to what are some of the concerns from UBS on BHEL. Hiral.
UBS has reiterated a sell on the stock, and they've reduced the target price to rupees 70 from 115, and this is the lowest target price that we have in terms of a BHEL is concerned. Now what they are saying is that the quarter 3 results have reconfirmed low gross margin trajectory for this counter, and BHEL is likely to even report a loss till FY18. Revenues are expected to remain muted till FY17, and they are expecting an increase in terms of where the fixed costs are concerned, which is expected to hit FY18 numbers as well. Now, after the decade reset in salaries that are due in Q4 of FY17, even marginal revenue disappointments could push the company to losses even beyond FY18 earnings estimates, and the net losses that are expected over FY16 to 18 could be higher than what they are estimating if provisions also remain elevated for this counter. In terms of the project pipeline, if you go to see, as per UBS, even that looks long prima facie, but that is unlikely to drive the order book growth going ahead. And if you see BHEL's order book, that is expected to stagnate around current levels even over the medium term. What UBS is saying is that if you see the Indian power market also, that is also clearly stating an oversupply situation, on the back of which we will see this kind of a situation for BHEL. And in terms of valuations are concerned, they are valuing BHEL at 0.5 times FY17 estimate of price to book value. And in terms of the stock price, that is already in a gradual recovery in terms of our order inflow as well as earnings are concerned. And currently, if you go to see, the stock is trading at a significant discount to the company's 10-year average price to book value multiple, and deterioration in the return on equity has been pretty sharp. From an average ROE of 24% over the past 10 years, they are expecting the ROEs to remain negative over the next 3 years, that is over FY16 as well as 18. So in terms of evaluations are concerned over there, also they are seeing some bit of concerns, and order book is expected to remain at current levels in the medium term.
All right, Hiral, thanks for getting us those updates. Mayuresh, any thoughts on this when we talk about the cap goods space? Brokerages once again coming out and downgrading a couple of these names here. Any view on BHEL and L&T?
No, clearly, I think the sector is going through painful times. So if you look at how the order books are panning out for a large portion of the sector, I think you've seen from L&T results, there have been downgrades both in terms of revenue and order guidance given by the company. So generally, I think the order flows are muted. I think what margins these orders come with, again, is one big monitorable to be looked at. Execution remains a key monitorable risk. And again, I think the net working capital cycle remains pretty high. So I think it's quite spread out evidently on all these four parameters across the capital goods sector as a whole. So clearly, I think BHEL has been underperforming based on all these factors: dwindling cash flow position, execution issues, the probability of order wins, specifically on the BTG element that it operates out of, being extremely low. L&T, again, I think it has revised its guidance downwards on the order and its revenue flow. So clearly, I think you're seeing painful times continuing. I think we're not seeing any improvement happening, at least in the capex cycle over the next 2 quarters. But at least L&T within the cap goods space remains our long-term preferred bet. But again, I think one needs to accumulate the stock on declines and in a very slow and gradual manner. And we may be holding these positions in our PM schemes as well.
All right, so that's as far as the engineering pack is concerned. Now, with the budget 2016 just 10 days away, expectations are running high that Arun Jaitley will announce increased spending for building India's infrastructure. We put the spotlight on the cement sector that will usually benefit from the government's infra push. Piyush is joining us with what's on the wish list this time around. Piyush.
Absolutely. So I think cement sector, what would be the top on the wish list of the sector would be the rationalization of freight rates. Over the last few years, there has been a steep hike in different kinds of royalty and freight rates. So the first would be reduction in the railway freight rates. Then the second would be uniform excise duty versus the ad valorem duty and the volume specific duty. And then the cement sector would also like to have imposition of customs duty so that the competition basically can be averted. And the fourth and the most important is, as the government actually spends more on the rural housing, the affordable housing, infrastructure, that will be directly related to the boosting demand. So the most important for cement sector would be that government actually increases allocation towards roads, towards infrastructure, and all these basically would be a good sign for the cement sector. Perhaps in the same line, the stocks which would be under focus would be ACC, Ambuja Cements, Ultratech, and looking at the valuation also, in terms of the leverage, ACC and Ambuja, they stand out because of a very strong balance sheet. But in terms of Ultratech, it has a much large capacity and also again decent leverage. Companies like India Cement would be having a very over-leveraged balance sheet, so perhaps they would not be in a position to expand capacity and take advantage of boosting demand if it happens.
All right, Piyush, thanks for those updates. Mayuresh, any thoughts here when we talk about the cement pack and how that how that's really panning out? Because Ultratech's been somewhat of an outperformer in the last couple of sessions, but going into the budget, what are your expectations and what should one be watching out for the cement sector?
No, clearly, as Piyush was mentioning, I think the wish list is always that increased spending come through, specifically on infra and housing. That's where the government focus and intent has been. So I think any increased allocation on that front is definitely going to aid pan-India players. So in that sense itself, Ultratech's numbers have been quite encouraging, decent set of numbers even in the quarter gone by, both in terms of how volumes have panned out and how the bottom line has grown. With relation to cost prices, I think with increased petcoke consumption and lower power and fuel costs, you're probably seeing margins sustained for these companies. And it's an entire story on how the volume and the demand recovery happens, which will give stability to their realizations going forward. So clearly, I think Ultratech is something that we'll continue to prefer in the top tier names. Orient Cement, with its new capacity commissioned at Gulbarga, lower lead distance time, which basically means that between 2 points, I think the lead distance is quite low. And again, I think the cost of production is one of the lowest among the mid-cap cement peers. So clearly, I think Orient Cement's numbers should improve gradually over the next few quarters, and valuations are also not that expensive.
All right, so that's as far as cement pack is concerned. Take a quick break, but up next, will the bad bank concept become a reality? We talk to M. Narendra from Assocham and Abhishek Bhattacharya of India Ratings. Stay tuned, that's coming up in a minute. Welcome back. You're watching Lunch Money on Bloomberg TV India. Now, just a quick check as far as markets are concerned first and how that's really panning out. The benchmark indices again having a little bit of a slow Friday, 0.4% lower, 7165. The 7200 continues to be a little bit of a resistance zone for the market and still unable to see a convincing close above that. Let's see if the second half turns out to be any different. But the focus clearly will once again remain on the banking sector. And the government is actually looking at a proposal to set up a bank or a company to deal the rising bad loans of state-owned banks, even as the views on the issue are vertically divided. To discuss this further, we've got with us a good panel this afternoon. M. Narendra, Chairman of Assocham, National Council for Banking and Finance, is joining in. We've also got Abhishek Bhattacharya, Associate Director at India Ratings. Mayuresh Joshi is also in conversation with us. He'll also stay along for this chat. And also my colleague, Shraddha Babla, is going to be joining in to the conversation. Thank you so much for taking the time out. Mayuresh, quick comment here when we talk about what's happening as far as efforts are concerned in somewhere trying to resolve this entire banking mess.
No, clearly I think the efforts probably by the governor are in the right direction in terms of cleaning up of balance sheets. And probably it's in the right direction too. So I think the Supreme Court directive of asking for a defaulters list is also something in the right direction. And again, I think this points out to the intent that the government and the court has in terms of cleaning up of balance sheets as far as the legacy issues are concerned. So I think it's a step in the right direction. How it gets implemented and in what form, I think that is going to be important, key monitorable going forward.
All right, Mayuresh, fair enough. Thanks for your time today and sharing your perspective on markets as well as a couple of the sectors that we are focusing on. But let's also bring in M. Narendra, Chairman of Assocham, National Council for BNF.